Welcome back to the Deep Dive. It is Monday, November 24, 2025. And if you're watching the markets, you know exactly what whiplash feels like right now.
It's true.
We are standing at this geopolitical and financial crossroads. It's defined by just a massive surge of market optimism, meeting some seriously entrenched structural uncertainty.
That's a perfect way to frame it. Our mission today is really to unpack this specific moment in Q4. We've got some very specific source material market analyst reports, central bank speeches, confidential trade summaries.
Okay.
And we need to understand this powerful short-term surge we saw today, driven almost entirely by Fed rate cut expectations, and how that sits alongside these long-term friction points.
Geopolitical instability, the AI productivity paradox.
Exactly. All of it.
Okay, let's unpack this. We have to start with the calendar because that really dictates the risk profile here. The U.S. market is entering a high-risk, holiday-shortened trading week.
Right, Thanksgiving.
We're totally closed on Thursday, and then stocks close early on Friday, 1 p.m. Eastern. Now, this severe lack of trading liquidity, it just means the market is incredibly sensitive. It's highly susceptible to sharp, unexpected reversals if any big news breaks.
It creates a vacuum where conviction trades can become extremely amplified. And that illiquid background is exactly what made today's rally so potent.
A risk-on commitment right before the holiday.
Exactly. Investors were willing to push hard.
So let's look at what drove Monday's action, because, this was not a marginal move. It was a huge defining day.
It really was.
The primary propellant was overwhelming confidence in a December Federal Reserve rate cut. This conviction, it followed what the street interpreted as dovish commentary from the New York Fed president.
The market heard what it wanted to hear, and the numbers, they just reflect that conviction. Right now, the CME FedWatch tool indicates an astonishing 85% likelihood of a quarter-point cut in December.
85%.
Yeah, and the results of that sentiment were immediate and sector-specific. The tech-heavy Nasdaq composite soared a staggering 2.7%.
That's huge.
And the bellwether S&P 500 rose 1.6%.
What's so fascinating to me here is the clear rotation. It wasn't just the mega caps rising.
Wow.
We saw true rate-sensitive sectors, the small and mid-cap indices, just significantly outperform.
Right. They closed up between 2.5% to 3%.
So what does that level of rotation tell you about what investors are expecting?
It tells you they believe the cycle is turning, and they're willing to take on a significant growth risk. These smaller companies, they benefit disproportionately from cheaper credit.
Sure.
So when you see small and mid-caps outperforming like that, it's a commitment to a broader economic recovery, not just, a few tech winners.
And conversely?
Conversely, the defensive consumer staples sector lagged. It confirms that investors are abandoning safety in favor of growth assets.
And here's where it gets really interesting, tying that conviction directly into the AI narrative. Alphabet Google surged 6.3%.
A massive jump.
And it was fueled by the unveiling of its highly anticipated AI model, Gemini 3. But it wasn't just Google's own press releases.
No, that third-party endorsement was key.
Oh.
From Salesforce CEO Mark Benioff, he was quoted saying, after using the model, it feels like the world just changed again.
That kind of high-level validation just adds serious fuel to the fire.
And we saw the same thematic conviction with Tesla, which jumped nearly 7%. This was after Elon Musk talked up the company's advanced AI chip capabilities. He made a claim that they expect to build chips at higher volumes ultimately than all other AI chips combined.
Which is just a staggering claim.
It is, but it directly feeds into this massive AI capital expenditure narrative that's dominating the tech sector.
And just to amplify those already robust gains, we had a technical factor at play, didn't we?
We did. The MSCI quarterly index rebalance executed right at the closing bell. Technical trading on that scale, it just tends to amplify existing momentum.
Especially in those high-weight mega caps.
Exactly. It created a really powerful tailwind. It's important for you to remember, though, the global context here. While the U.S. market was surging, the Japan Exchange Group, the JPX, was completely closed today for a holiday.
So a massive global market was just out of the price discovery game.
Right. It really highlights the asynchronous risk exposure that defines this environment.
That brings us to the foundational theme underpinning all this tech enthusiasm.
Yeah.
Just the vast investment in AI. The scale of capital being thrown at this sector is truly staggering.
It is.
Global corporate investment in AI reached $252 billion in the past year alone. And if we zoom in, the 4 U.S. AI hyperscalers, Alphabet, Amazon, Meta, and Microsoft, They're going to spend around $300 billion this year alone,
Just on data center infrastructure.
just on infrastructure.
But level of capital commitment is unprecedented. But it introduces what we call the paradox. On November 24th, ECB President Christine Lagarde gave a major speech that addressed this head-on. She stated, quite clearly, that the aggregate economic impact of AI is still barely visible in the data.
That is the famous Solow paradox, isn't it? The old joke about seeing computers everywhere except in the productivity statistics.
Precisely.
So Lagarde is suggesting we're seeing AI everywhere, in the news, in stock prices, in the capital spend, but not yet in the official GDP numbers.
Exactly. And history reinforces this concern. Earlier technologies, like electricity, they took around 30 years for broad productivity gains to really show up clearly across the entire economy.
A massive decades-long build-out.
Right. It required a total reallocation of labor. So the big question is, will AI follow that same decades-long timeline, or will it be faster?
What's the argument for a faster adoption curve this time around?
Well, Lagarde offered some optimism on this point. She suggested AI could spread faster because it runs on existing internet devices and it communicates via human language.
Oh, okay.
Critically, this means the diffusion, the adoption and usage can happen before the full completion of that massive infrastructure build-out. Many AI applications can deliver early-stage gains even on existing hardware.
So the benefit curve could steepen sooner.
That's the hope.
So what does this all mean for the investor right now? The core challenge seems pretty simple. The current high valuations, especially for these high-growth tech stocks, they're based entirely on immense expected future productivity.
Exactly.
If that productivity dividend doesn't accelerate rapidly, the market's current enthusiasm is likely exceeding reality. The bubble risk is real.
And the valuation pressure is acute. The forward price-to-earnings ratios for the S&P 500 are hovering near 23 times earnings. That is firmly above historical averages.
And it forces a strategic rethink globally.
It does. For regions like Europe, Lagarde noted their goal isn't to try and outbuild the leading AI models. It's to prioritize rapid adoption across traditional industries.
Turn a late start into a competitive edge through efficiency, not creation.
That's the strategy.
Okay, moving to the broader macro picture, let's inject a dose of reality against today's euphoria. What's the Q4 2025 consensus for the U.S. economy?
The projection is for positive, but distinctly below trend growth. We're expecting it to be near a 2% annualized rate for 2025.
And consumer spending is holding it up.
It's the main support pillar, but the forecast faces pretty significant headwinds, notably the drag from the federal government shutdown that began back in October.
That shutdown had ripple effects, didn't it? Beyond just halting services, it delayed economic data releases.
Absolutely. And that just complicated the Fed's decision-making and added friction to consumer confidence heading into Q4. And compounding this slower growth is the persistent inflation struggle.
You have to look at the Fed's preferred metric here.
Always. Core PCE. That's personal consumption expenditures, excluding food and energy, and it is forecasted at 2.9% for Q4 2025.
Stubbornly high. Nearly a full percentage point above the Fed's 2% target. So you are navigating an environment where inflation is sticky, but growth is projected to slow.
That is the definition of a precarious balancing act. And that precarious balance, it translates into tangible risk. S&P Global assigns a substantial 30% probability of a U.S. recession in the next 12 months.
30%.
Yeah. This high degree of uncertainty, it reinforces the strategic role of defensive assets. Gold, for instance, has maintained its role as a critical hedge against inflation and, structural debt concerns.
So given the illiquidity we mentioned for this holiday week, what's the single biggest near-term risk event for market confidence?
It has to be the delayed U.S. retail sales report. It's finally scheduled for release midweek, just ahead of Black Friday.
Okay.
Think about the narrative. Consumer resilience is the primary defense against recession. If that report provides a negative surprise, a sign the consumer is pulling back, and that news hits during a low liquidity period.
It could do profound damage to confidence.
Exactly. It could trigger a sharp, disproportionate market correction.
Let's shift our attention to the global stage, starting with the trade dynamics. We did see a temporary trade reprieve earlier this month, right? In early November, the U.S. and China struck a deal.
They did. That agreement provided some immediate relief. The U.S. agreed to lower tariffs on certain Chinese imports by 10 percentage points and, critically, extended the expiration of specific Section 301 tariff exclusions until November 2026.
Making sure those taxes don't disrupt the holiday shopping season.
Yeah, that's the short-term goal.
And what were the major commitments from Beijing in return?
China committed to two specific measurable actions. First, they agreed to effectively eliminate export controls on rare earth elements.
Which are crucial for U.S. tech and manufacturing.
Crucial. Second, they resumed significant purchases of U.S. agricultural goods. They're committed to buying at least 12 million metric tons of U.S. soybeans during just the last 2 months of 2025.
So it's a very clear transactional trade reprieve designed to smooth over immediate tensions. But you said earlier, this doesn't solve the structural friction, does it?
Not at all. The underlying U.S.-China great power competition, that remains the primary driver of global geopolitical instability. The U.S. administration's foreign policy is increasingly transactional.
Meaning tariffs are being used for geostrategic purposes, not just economic ones.
Right. And the long-term implication for you, the investor, is structurally higher inflation and lower global growth. It's due to increased protectionism and supply chain reshoring.
And compounding that friction is the whole issue of digital regulation and market concentration. Let's look at the numbers here. 7 of the world's 10 most valuable companies are digital giants.
The concentration is staggering. The combined share of sales for the top 5 digital multinational enterprises has more than doubled, from 21% to 48% between 2017 and 2025.
From 21 to 48%.
Yeah, and that dominance has provoked a powerful global regulatory pushback, especially in Europe. We're seeing the rise of what they call ex-ante competition regulations.
The EU's Digital Markets Act, the DMA, the Digital Services Act.
Exactly. These aren't old-school antitrust cases. These rules are designed to preempt unfair behavior before it can harm competition.
And has this regulation actually changed behavior?
It's had a measurable effect on strategy. The crackdown on killer acquisitions where big tech buys up rivals to eliminate competition has been dramatic. Those deals fell from 58 in 2019 to just 22 in 2024.
So it's forcing them to innovate organically instead of just buying their way out of risk?
That's the idea. And this isn't just a European issue, it's global. We've seen major fines everywhere. The EU fined Apple and Meta, Nigeria fined Meta, Indonesia fined Google, and back in 2021, China fined Alibaba.
So it's a coordinated global effort. But Washington has pushed back.
Often, yes. The U.S. views some of these foreign actions, like the EU's DMA, as potential trade barriers to American economic dominance. It just adds another complex layer of geopolitical tension to the tech sector.
Okay, let's pivot and connect some of this week's key corporate headlines back to those broader themes. We can start with Zoom. They reported Q3 results that beat expectations.
Right. $1.23 billion in revenue, and they raised their full-year adjusted EPS guidance.
But the real story isn't just revenue, is it?
No, it's the transition to margin optimization. Their adjusted operating margin surged to 25.2%, up sharply from 15.5% last year. It reflects the broader corporate theme, a laser focus on profitability and efficiency.
A post-pandemic shift.
Exactly. Zoom shows you that shift is working.
Meanwhile, the healthcare sector saw a sudden surge today. Health insurer stocks, Oscar Health, Centene, Molina, they all jumped. What was behind that?
This is a pure policy risk trade. The surge followed reports that the White House is expected to pitch a 2-year extension of the Obamacare subsidies.
Oh.
If those subsidies get extended, it dramatically stabilizes the consumer base for these insurers. It guarantees higher enrollment and predictable revenue.
Policy certainty translating directly into market gain.
Precisely. But not all health news was positive. Novo Nordisk stock tumbled 5.5%.
Right. This is after a trial failed to confirm that semaglutide, the active ingredient in Ozempic and Wegovy, could help slow Alzheimer's.
Yeah, and this highlights the immense valuation risk tied to drug development. The market had priced in these transformative opportunities beyond weight loss. When those high expectations aren't met, the adjustment is severe and immediate.
And let's look at structural supply chain pressures. Kohl's shares rose 2% after appointing a new CEO.
And they're focusing on a turnaround plan emphasizing high-margin segments like jewelry and private labels. It's a classic optimization play.
At the same time, Tyson Foods shares jumped 5% today after they announced they would right-size its beef business.
And that's due to an anticipated operating loss of $400 to $600 million in fiscal 2026. This isn't just internal management. This is a direct response to structural commodity inflation and a severe cattle shortage. They're trying to get ahead of a massive long-term supply chain issue.
So on one hand, we have markets roaring higher on Fed hopes, but under the surface, the real economy is showing us a very mixed picture of cost pressures, friction, and a desperate search for efficiency.
To summarize the core tension for you, You are navigating an environment where market confidence is absolutely prioritizing near-term rate cuts. That gave us the massive rally today.
Right.
Yet the underlying economic engine, it signals below-trend growth, and persistent inflation measured by core PCE remains stubbornly forecasted at 2.9% for Q4.
So the key challenge remains. Success hinges on selective growth. Investors have to capitalize on the AI infrastructure build-out right now while the market waits, kind of impatiently, for that productivity paradox to finally resolve itself.
That barely visible gain Lagarde talked about, that wait could be months or it could be years.
Exactly.
And that leads us to our final thought for the week. Geopolitical tensions mean that market volatility is expected to significantly increase in Q4. Given the high probability of a December rate cut suggesting central banks are adapting policy to support expansion, how will you protect your long-term strategy if the Fed's political pressures lead to a sustained long-term acceptance of moderate inflation, eroding the real value of cash holdings over time?